This is Wealth BT, a podcast of BT correspondents.
Have you ever invested in a structured note? Structured products have been around for decades, sometimes in a fund, or most often in a note format. As a note, the investment can be pretty short-term, set to mature in just weeks. A note can be linked to almost anything, a currency pair or a stock or a basket of indices. In fact, when you listen to a pitch on structured notes, it may sound like you get the best of both worlds. A yield, which is slightly higher than a fixed deposit, plus an upside and maybe even a return of your capital. But do such notes really give you the best of everything? What are the most important things you should be aware of before you invest in a structured note? Welcome to Wealth BT. I'm your host, Genevieve Cua, Wealth Editor of the Business Times. Every week, my colleagues and I break down a business story that matters. My guest in this episode is Franck Fayard, Head of Marex Financial Products for the Asia Pacific. Welcome, Franck. Thank you for sparing some time for us.
Thank you, Genevieve. It's a pleasure to be here.
Here's some background first on Marex. The company is a financial services platform listed on the NASDAQ. It provides services like liquidity and execution to institutions like banks and trading houses, which may be trading energy, commodities, and other financial markets. The financial products division, which Franck heads, has so far structured more than $30 billion worth of investment notes and thousands of products linked to all asset classes. Let's get into it. So Franck, structured notes aren't a one-size-fits-all. Let's look into the basics first. What are they and why are they so popular?
Genevieve, you're absolutely right. The great value proposition of structured notes is the ability to customize the investment product to each of investors' needs. The return expectations can be customized, but also the product can be tailored to the risk tolerance of the investor. That's a great value proposition. Risk and return can be tailor-made. I came to Asia about 15 years ago, and I was surprised about how savvy about structured product Asian investors can be as compared to Europe. The market for structured products in the region are very mature and can be quite sophisticated in terms of the product. A structured notes is essentially an investment product in a form similar to a bond, with an additional mechanism that's linking the product to another financial asset. This financial asset can be single stocks from the major exchanges, US, Europe, Japan, Hong Kong for the most, can be equity indices, can be cryptocurrencies, currency pairs as you mentioned, but also long-term or short-term interest rates. We also do a lot of commodity-linked structured notes, which have become popular, especially when linked to precious metals. Most investors come to structured products for the enhanced yield, double digits for the most, but also for the short-term investment, 3 to 6 months, sometimes up to 12 months maturity on average. In a market like Singapore, the most popular type of structured notes have been equity-linked notes, also known as ELN, fixed coupon notes, known as FCN, also credit-linked notes, known as CLN, and also another popular type has been fixed-rate notes, known as FRNs.
Franck, you've mentioned some of these common structures, but there's also the capital-protected notes, which I imagine Asian investors really like. How do these work, and what assets are typically used as the underlying?
Yes. In one of your previous podcasts, I remember you were telling listeners how to keep calm and stay invested. That's exactly what capital-protected structured notes are about. Over the past year, we've seen a great demand for capital-protected structured notes. Such a structured note is designed as a combination of a zero-coupon bond and an option. And basically, the yield coming from the zero-coupon bond is used to purchase the option that's giving the exposure to the other financial asset that I mentioned just before. The most popular example of capital-protected structured notes is also of a very simple form. It's the one I mentioned before called fixed-rate note, also known as FRN. In fact, those type of fixed-rate notes with maturities between 1 year to 3 years have proved to be pretty interesting alternatives to traditional money market instruments. Investors choosing to go for fixed-rate notes can tailor the maturity of their product, the currency, and also the coupon rate. The pickup given by such fixed-rate notes can be around 100 to 200 basis points above the risk-free rate. It's a pretty good value proposition for investors.
Right.
And they come in the form of an investment grade rated note.
There are some factors that influence how a note is priced and, effectively the yield that they can give. Factors like volatility and interest rates. How do these factors help or hurt a note?
You're right. Those two elements, rates and volatility, are really at the center of the creation of the product. As I said, the yield from a bond is used to invest or to purchase the option mechanism. That option mechanism, the option can be put or call or more structured or exotic option, is linked to volatility of the underlying. And usually the higher the volatility, the more expensive this option. It's also a reason why we always advise investors to structure this product at the time when volatility is relatively low, to avoid overpaying for a high level of volatility when creating their product, which is how capital-protected structured products are designed, using a yield to purchase an option, which price is linked to the level of volatility in the market.
For example, in today's market where the view of the US dollar is quite volatile and people believe that maybe it's in a structural decline, this isn't the right time to take up a note? Or would it depend on the currency pair?
You're right. So basically playing on such a view can be done, the financial assets we mentioned before can be the underlying of the product. So a structured note could be designed to play on a bearish trend on US dollar, either as a straightforward play or just as a hedge, buying a put option on the US dollar, which may be an additional component on our portfolio of US dollar-based assets, call it US dollar equities or US dollar bonds.
Yeah. So that leads us to this question that I have. How important is it that an investor going into a note takes a directional view, takes a bet that this asset will go up or down?
What's very interesting in structured notes is you tend to make them according to your convictions. And convictions can be bearish, expecting downside evolution of the underlying, can be bullish, can also be range band, meaning that some structured product can be designed to benefit from an underlying that wouldn't deviate too much from the current level. And sometimes the same product can play on different views. Just depends on where you set your strike level and your knockout level in the product. A product can be having an early redemption feature or a coupon trigger level that's set to be above the level at start of the product, but can also be with a buffer. That buffer allows the underlying to still go down from initial level, but without harming too much the note holder.
Still to come. What happens in a structured note when the market moves against you? Can it be unwound?
Breaking news from the Business Times podcast team.
Hi guys, this is Emily Liu, your host of Market Focus Daily. I've got some great news. Come July, Market Focus is getting bigger. I'll be bringing in market and investment experts into the studio to share analysis and opinions on what moved the markets and what to look out for in the week ahead. Every Friday, starting on July 4th.
Look out for Market Focus Weekly from the Business Times or wherever you get your podcasts.
And now, back to Wealth BT, a podcast of BT correspondents.
Welcome back. In case the market moves against you, as it did during the famous Liberation Day announcement of Trump tariffs, what options are open to you in terms of unwinding the note? How can Marex help, Frank?
Yes, it's true that the recent months I've seen elevated level of volatilities, especially around Liberation Day. And I can really tell that volatility has been volatile. It has proved difficult for investors to get it right on their bets, whatever the financial markets. For the large majority of the structured notes issued, the issuer of the note commits to providing a secondary market in the note, meaning that the holder of these notes can come back anytime to the issuer to get an unwound price, anytime under normal market conditions. And the cost for this is embedded into the price. That's the typical exit scenario. Now, at Marex, we've been proactive to our investors, proposing them to restructure their note that were underperforming because their bet wasn't right or maybe not done at the right time. So we've restructured product, and a typical example of restructuring could be to extend the note. Let's say the structured note has a remaining maturity of about 1 month. The proposal can be to extend it by another 3 to 6 months to give the investor more chance, more time for the underlying asset to recover and for the investor to recover the full principal at the maturity of the product.
So we talked earlier about fixed rate notes and how that is the most popular structure for a capital protected note. Theoretically, if you enter into a fixed rate note with a maturity of, say, 6 months or a year, and in between something like Liberation Day happens, because your maturity is still a little bit further out, then you're still fine. Is that right?
Yes. Structured notes, by definition, are formula-based products. They deliver the formula at the maturity. Or it can be in cases of early redemption, but which again are planned according to the formula in the term sheet. The scenarios are set and transparent. Now, when investors want to unwind, of course, the unwind price is based on the existing prevailing market condition. But it's very common that, let's say, for a structured note of a 6-month maturity, the market may go in the wrong way for the first few months and may recover such that at the end of the product, at the scheduled maturity, investor will still end up with the best case scenario and their expected return.
So Marex was among the first to come out with notes linked to Bitcoin. Tell me about this. For investors who want to take a bet on Bitcoin or other crypto assets, what types of structures are popular? Do they remain popular?
Thank you, Genevieve. I love this topic. A little bit of recent history. A year ago, in January 2024, the US regulator, the SEC, approved 11 ETFs linked to Bitcoin, physical ETFs. The day after, Marex has issued the first ever structured notes linked to the largest of these ETFs, the iShares Bitcoin Trust, also known as IBIT. Today, fixed coupon notes linked to this ETF, IBIT, is our most popular crypto-linked structured notes in Singapore. We also design a lot of such products based on baskets of crypto underlyings. It can be a mix of coins and crypto-related companies. So this has been a major event, the approval of these physical Bitcoin ETF, because it was really the step one of a large democratized access to crypto markets by investors, from private investors to institutional investors. Structured notes is the step two, allowing investors to really customize their risk and the return to their market view and expectation linked to the crypto markets, whatever the coins. But let me share just a brief example. I was talking about fixed coupon notes linked to crypto underlyings. Let's say an FCN of a 6-month maturity denominated in US dollars issued by Marex with an investment grade rating linked to a basket of 3 crypto underlyings, including this IBIT ETF, will return a yield in the form of a coupon of 24% per annum. Not bad, huh?
Based on today's prices?
Yesterday,
okay. Sounds really good. But I'm going to pull back a little bit to ask you, what do you see are the biggest mistakes that investors may make when they go into a structured note?
Don't follow your friends. No. Structured notes are a fantastic instrument to express a market view. So the investors who do well with structured notes are those really there expressing the convictions, their market views. It doesn't have to be completely against the market consensus, but they have to follow their own views, their own path, rather than following other people. Because when they follow, then they chase the trend. They may be late on the trend. Whereas if they follow their own instinct, they may be wrong, they may be right. But if they're right, they might be right at the same time. Then the market timing will play in their favor. Also goes for not only expressing convictions, but also for hedging, for example, or for going into more conservative modes. You know, investors switch from aggressive to conservative, risk on, risk off. So when switching to risk off, be it by hedging the portfolios with hedging tools like buying protection, put options, or by going into more conservative products like capital protected notes, they have to do it at the right time, such that they don't pay a too high price, because when the storm is here, volatility is high and the cost of options is also high.
Would it generally be the case that the shorter the tenor, the better?
Investors usually tend to go to mix the maturities of their products and for different purposes. And again, as a comparison between Asian products and the European products, the maturities are much shorter in Asia. On average, most of the fixed coupon notes linked to equity markets, US markets, Hong Kong markets, or Japan markets, have tenors between 3 to 6 months up to 12 months. But in the past few years, we've seen investors going into much longer dated structures, sometimes up to 30 years.
So going back to your crypto example, where you can get a note for a yield of 24%. In normal investments, people would say, be careful what you ask for, meaning that the higher the yield, normally the higher the risk. Does that hold for these notes?
Yes, this is true. The evaluation that all investors have to make is whether they feel they are being compensated enough for the risk they are taking. Financial markets, and here we're talking about very liquid underlyings, which are being transacted by institutional investors, market makers, brokers around the world, are pretty efficient. So usually the level of risk is pretty tightly priced. There might be some dislocations occasionally, which make the happiness of alternative investors like hedge funds, for example. But for the majority of private investors and reasonable institutional investors, when they go into specific markets, the level of volatility that they will access or buy and the level of forwards and rates usually reflect the compensation for the risk they are taking.
In your view, where do such notes fit in an overall portfolio?
There's a few categories of structured products. The majority can be streamlined to yield enhancement products or downside protection products, meaning that you can get exposure to US equities by buying the stocks outright, but you can also choose to go for a yield-enhanced product, fixed coupon note, giving you a return that would be a multiple of the yield you will get, for example, from the dividend of that stock, still by playing on the same convictions you may have on the underlying. That's typical yield enhancement. So you can have a portion of your equity exposure by direct or outright investment in the stocks, and complement with a higher yielding investment in the form of a structured note. And same goes for the downside protection. That's what we've seen recently for crypto markets, for example, where the most simple way to invest in crypto market can be to either to buy the coins through a wallet, but it's complex in terms of infrastructure and access, or they can also buy an ETF. That's a bit easier. With such plays, which are being called Delta 1, they have full exposure to the upside and the downside. They have full return, but also full risk. In addition to this product, in their crypto bucket within their asset allocation, they can choose to add capital-protected structured notes linked to the same underlying. The benefit of this overall would be to reduce the volatility of the crypto bucket in their portfolio.
So I think maybe in other words, an investor has to be prepared for the trade-offs. I mean, there's always a trade-off, isn't it? Say I get the yield, but I wouldn't get the full upside, for example. But I get some downside protection as long as an investor, I'm aware.
Correct. And fixed coupon notes paying a high guaranteed coupon with the potential to be redeemed earlier than the maturity. Those products are not really expressing a high conviction, but we say they express a scenario, a non-extra bearish scenario. So the underlying stocks, you should expect them to be non-extra bearish over the term of your product. So structured notes can express a high conviction, but can also be a way to get a yield in a rather neutral, range-bound, or within like an average market scenario.
Okay, thank you, Frank.
Thank you very much, Genevieve. It was a pleasure.
There you have it. Our structured notes for you. I have a caveat, though personally, I haven't invested in a note. My husband has. And in the few times he's gone in, he's been caught wrong-footed. So, no, it hasn't been a happy experience. But I can see where notes might make sense, really as a tactical tool. Like if you're heavily exposed to some asset like the US dollar, which is now seen to be in structural weakness, you may use a note to hedge that. Or you're unsure of the market direction of an index like S&P 500. A note may help you earn some income as long as you're aware of some downside risk. As always, I hope this episode has helped you weigh your options. BT Correspondents will be back next week with a new episode on transport, so do check it out. Until the next time, I'm Genevieve Cua. Thank you for listening.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts. Or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.